Good morning, good afternoon, good evening, folks. How you doing today? Michael Zuber, one rental at a time. I'm back with my good friend Stephen Dow from Velocity Mortgage. How you doing, sir?
I'm doing pretty good. Yourself?
I'm doing great, man. So one of the things I wanted to do in our first conversation of three, yes, folks, we do three conversations with our experts every week, is I want to talk about the space of non-QM versus bank versus hard money. But before we have that conversation, Stephen, we got to talk about and have that marketing little tidbit so we don't get in trouble.
Yes, sir. I'll get that out of the way. Although I work for Velocity Mortgage Capital, all the ideas and topics discussed on this channel are that of my own. And let's get this going again, please.
Yeah, folks, we've had a couple of fits and starts, but it's just funny to get started. But what I want to do here, Stephen, is I want to talk about the non-QM space from an outsider's perspective, right? You've been in the business a couple of decades. And I just want to kind of give you my opinion and see, just see what you think of it. Because again, I think non-QM fills a huge need, but it was born out of basically a hole in the market, right?
Right.
So lots of people that I talk to and I help with are familiar with bank mortgages, right? 2.88%, I think was the average rate I saw this morning published. They hear about that stuff. They probably know 30-year, 15-year, things like that. If they've been in the real estate investing game for more than a minute, they probably also have heard of hard money, right? 10, 11,
Right.
12% interest only, couple of points, short term. And then there's like a big gap, right? 3% money, 10% money, right? That's a huge gap. And I guess that's the first thing I recognized when I thought about non-QM lenders is non-QM is like, hey, there's a huge market between bank money and hard money. Let's go get in the middle of that. That's the first thing I thought of. Is that kind of a fair assumption, maybe?
Oh no, 100%. Again, just like in politics, we don't fit into just one side or the other. Most of us are
in the middle, yeah.
somewhere in the middle. So in a lot of cases, if you're not strict cookie cutter for banks, then you're kind of have to be forced to use hard money, especially in the 2010, 2011 when banks were saying no. Yeah. So again, you're only forced to be using hard money. So as time progressed and more investment dollars kind of came back to Wall Street, people started, like you said, looking at what the need is. Let's try to fill it, and if it makes sense, then we can package it back up and we underwrite it at a certain risk level. It made sense for everybody. So slowly, market started to respond back. Property values started to stabilize, and all the numbers and everything else were making sense. So no, it really provides a lot of flexibility, especially for anywhere, somewhere. Beginning investor all the way to seasoned investor that's already surpassed the limitations for conventional financing. So it's a really great flexible tool because depending upon your situation, depending upon property type and a lot of other, things that normal conventional doesn't allow you to, but also you don't want to go to hard money because of the cost or the less advantageous terms, because it's typically short-term money or bridge financing. So, you don't want to be stuck in that, especially in inflationary environment. So
in a market that's evolving or slowing down, that short-term money, that's what gets you. I mean, that's right. I mean, there's a very popular guy named Dave Ramsey that went bankrupt because he had short-term money, right? He had can you imagine having 90-day money? That's just insane, right?
Not in this market with COVID and all this stuff happening where it's like 3 weeks later, everything's shut down. Wait a minute.
What's going on? 90-day money. Crazy. Yeah, but that's and what I've seen in the non-QM space, again, total outsider, just I watch it from someone who borrows. It's also a lot more flexible, right? Because what I've seen with banks is they take the box from Fannie and Freddie, they add a couple of overlays on it, and then it's kind of like no exceptions, right? They got to tick the box. And if they have one blank or one no or one maybe, they're like out.
Because you run it through an automated system through DU or desktop underwriter, so it either has to kind of fit all the boxes or it doesn't. So it's literally automated. So like you said, if it doesn't fit, then
and that's really what I've seen. Another big difference for folks that are looking to do deals and get a pipeline going is a non-QM lender, again, is not DU or desktop underwriting, right? It's a human being, and a human being can look at the variables and go, hey, this is an exception we can tolerate. Which you can't in an online, compensating factors. That's another thing that I love about the non-QM space is they have, to use your word, compensating factors, and why more and more people need to look it up. So let's be clear, in my opinion, if you can get bank money, go get bank money. Go get 30-year bank money. But more and more people, as banks get tighter, as they grow their portfolio, debt to income, credit scores, whatever it is, everybody's going to eventually, I think, need non-QM lenders, because at least today, once you get to kind of 10 loans, they're like, out of here, right? No more. And then non-QM is the only answer. And then you could do portfolio loans. You could do 30-year money on apartments. There's just things that the traditional financing space won't do that non-QM lenders can, right?
Correct. And again, with a lot of the hybrid type loan programs with non-QM lenders allows a lot of flexibility given certain changes in circumstances with, these new variants that are coming out due to COVID. Sometimes you need a little bit of payment relief without having to refinance into some sort of bridge financing because of, the situation of non-paying tenants, things of that nature, or eviction moratoriums. Well, you still got bills to pay. What do what can you do? So if you got a little bit of equity, or you need somewhat of a bridge loan, but maybe more stable in a sense, we offer specifically a 30-year loan with up to a 10-year interest only option for you for the first 10 years of that 30-year loan. So now you have the stability of the 30-year fixed rate, but with the flexibility of payment relief when needed, and still pay down the principal when you can.
Yeah. So again, I want to talk about that program. Again, folks, we have a playlist on this channel. I think it's called Non-QM Stephen Dow, I think is the playlist. So go watch that. We talked about it 2 weeks ago. But just in brief, that product could be used for apartments, 5 units and above. It can be used on a portfolio loan, right? Multiple houses.
Yes. Correct.
Right? So again, think about that, right? You got 10 houses in Ohio, or 5 here, 5 there, 6 here, whatever they are. They're too small for a bank, right? Even too small for a credit union, right? They still don't like to do those 40K loans. You can do a portfolio loan. Lots of people ask me, where can I get a portfolio loan? Where can I get a blanket loan? Same thing. A non-QM lender is the answer.
100%. Because again, not a lot of the same limitations as compared to conventional, because we don't have that 10 maximum loans per borrower. And again, with the flexibility of the property types, because like you said, if your portfolio has some 1 to 4 unit residential or some multifamily, or even if you want to try to go into some commercial or even multi or mixed use, we also can do those property types. So a lot more flexible versus going to your bank, where they're not going to do those commercial, or if they do, they're going to be a little bit even a tighter window than regular residential commercial, or you got to use hard money, which no one wants to use hard money if they can help it. So
yeah, exactly.
Yeah,
very cool. Again, folks, non-QM offers a space. If I was in this game and I could get bank money, I would. Very clear. Let's be very clear on that. Matt, the mortgage guy, if you're in California. But more and more of you are doing deals. You're buying. See, the other thing that I think is going to happen here as the market slows down is we're going to get the opportunity as investors to buy what I call junk. It's stuff that's not going to qualify FHA, right? The bank's going to say no because of quality. But those are going to be the best deals.
100%.
Right? Because you're going to be able to get margin. You're going to get the motivated seller. You can get a discount based on inspections. There's just so many things coming our way. So people, if you are doing that today, you should probably reach out to Stephen Dow at Velocity Mortgage or other non-QM lender.
Correct.
Because they can be your best friend, right? You really do create relationships with your clients. And I've heard that from other one rental at a time viewers. They're giving you shout outs in the private group. So nice work.
Well, I appreciate that with your students, but definitely with creating that relationship, because several of your subscribers or viewers had mentioned that, they really wanted to build that relationship to find that one lender that they can kind of do anything with, versus just 10 different lenders to try to find, you got this product. So we're very flexible in the sense where if you've got compensating factors, sometimes if it's outside of the box as far as our normal, guidelines, and or the deal goes a little sideways, we can try to make exceptions to the rule given, your compensating factors, as we mentioned. So we had our first deal for one of your one of your viewers, but it went a little sideways at the end. But due to our flexibility, we were able to kind of still keep everything the same, given the fact that some of the new details came up that might have made it go sideways, but it finally closed. And so he enjoyed it so much in the sense of he saw our flexibility and that we were willing to work with him, in a make sense kind of situation.
Yeah.
The second loan. So now we're going on the second loan for one of your viewers. So cool. It's been going pretty well. Yeah.
What I would tell folks, if you're in the game, you're looking at other markets, you have a plan, share that plan, reach out. Because again, what you'll see in non-QM lenders is they want to understand you. They want to understand your vision, your properties, what you're going for, and they'll underwrite the deal kind of beforehand to see if they can get you a soft yes.
Correct.
Yeah, so I think it's just, and again, it's about speed and all of this. So it's something I think more and more people need to do. So Stephen, how do you want them to reach out to you if they want to kind of
Just real
run an
quick.
idea by you?
Yeah, email's the best typically. In the subject line, if you want to put ORAT, instead of having to type out one rental at a time, so I'll know, because I'm getting just bombarded with so many emails.
That's cool.
Because the fact that I'm also, the regional sales manager for our Austin, Texas office. So on any given day, there's a flood of emails coming in. So that helps to kind of, go to a specific folder so I can answer those a lot quicker. But that definitely would help out. And other than that, just general scenario and maybe mid FICO score.
Okay.
Other than that, address for the property, or at least the city and state where you're looking to invest in.
Yeah.
But from there, I could pretty much give you a pre-approval from that point. From that point, without having to pull your credit.
Nice. Again, folks, if you don't know, below in this show notes or description or whatever you call this thing on YouTube, Stephen Dow's email is there. It's sdow, DAO @velocitymortgage.com. Stephen, thank you very much. Keep doing what you're doing. I look forward to topic number 2.
Yes, sir. Looking forward to it. Thank you.